Alrighty, we are back with episode two, and today we are going to go down the rabbit hole of Austrian economics and their theory on money. I got my good buddy Justin here with me, and he actually has half a degree in Austrian economics and half in Keynesian economics.
Yeah, I got the best of both worlds. I went to a very small liberal arts school in the middle of nowhere, Virginia. That is a all men's school. In light of that, I wasn't going to. I was going to play baseball, and I was like, okay, I'll just take an economics degree. That sounds good. Like I can use that maybe. And then first ever class was Econ 101, and I walk in, and this professor pretty much, I don't remember if it was the first class or it was one of the first classes, and he's pretty much like, yeah, I'm an anarchist. And I'm like, what? So that was my intro to the idea of Austrian economics, which anarchy is in terms of anarcho-capitalism, which is a economic political ideology that pretty much is the whole idea of having zero or minimal government intervention when it comes to free market activities. And I don't know the exact true definition of anarcho-capitalism, and it varies from time period to time period, but I'm pretty sure it's like legit zero government involvement in any sort of economic free market activity.
Pretty much,
So,
basically, yeah, it's all left up to the free market.
yep.
So there's no state, no centralized power, no state control.
Yeah, no ability to set interest rates, no ability to subsidize businesses from failing, or
No
banks,
monopoly on
or
violence.
yep, no monopoly on violence. We can't coerce you to play by our rules.
No monopoly on
Obviously,
being able to create a currency.
yes, obviously this has not been implemented, and if it has throughout history, it is short-lived. Because I got this point the other day. Actually, I forget what book it was from, but it was this, and it was pretty relative. I was like, there are people in this world who are very, very gifted at, say, throwing a football or throwing a fastball or throwing a slider. Like, there are people that are very, very good at that, and then there are also people who are very, very good at coercing individuals into pretty much deviating a portion of what they ultimately produce and sometimes consume, and then ultimately
We're talking about
rallying.
theft.
Yeah, pretty much theft. Yeah, yeah,
That's what you're
and then
saying.
yeah, and then ultimately through many dark forms that are covered up very well, get I don't know, rise to those who know how to do it. So yes, there are those people that are ahead of the head of many many governments that know how
So,
to do this very well.
question for you. If I didn't have a clue what Austrian economics is, give me the 1 minute elevator pitch on what is Austrian economics.
Yeah, so again, it kind of does play into this idea, and it really starts at a introspective level of first off, what are you in in a working economy? You are an individual who ultimately has the right over himself, his thoughts, and his actions. So, human action, or as the Austrians call it, praxeology, ultimately is a very, very strong driver of Austrian economics. And this whole idea is that, again, we are all individuals and we all act and use certain means to obtain certain ends. So, again, that's the baseline of Austrian economics. The true foundation is that individuals act to obtain goals based off of values that they have. So it's different for everybody. It's different for you. It's different for me. It's different from somebody who's living in the middle of Afghanistan right now. It's different from somebody living in the middle of Hawaii. Um, there's a lot of factors that go into your surroundings that will ultimately change or deviate your actions. So again, the premise is human action is the main driver of economics, and ultimately
Okay.
people want to create a better life for themselves or put themselves in a better position. So they're going to economize. And then there's some other various points of Austrian economics, but this one we're going to talk about their idea of money and their origins and ultimately why it arises.
So I didn't even know about Austrian economics until I started my Bitcoin journey. I had no clue. It just was kind of, I was living in the matrix. And my first sort of exposure to it was actually a comment that my brother made about Keynesian economics when we were having a debate about, how do you create wealth, grow wealth, maintain wealth. And outside of kind of buying assets and just accumulating more dollars, he made a striking comment that said, you live in a Keynesian world where they're just going to print more money and debase your wealth, effectively stealing from you, and just keep kicking this proverbial can down the road of printing more money to get themselves out of debt. And so that was kind of the foray for me into down the rabbit hole. And then reading the Bitcoin Standard, you start getting introduced to these concepts that are the foundation of Austrian economics. So super interesting stuff, and different perspectives on it. And in particular, today's episode is going to be around the Austrian viewpoint or theory, how they look at money versus Keynesian, but we're predominantly just going to be focusing on what the Austrians think of around money.
Yeah, and it's one thing that was striking early on while I was listening to this anarcho-capitalist preach these ideas, and I was like, well, I've never heard of anarcho-capitalism. I've never heard of Austrian economics, but a lot of the basic points that he was ultimately preaching.
I think the underlying kind of viewpoint that Austrians have around money is one that it originates from barter as a medium of exchange. Certain goods, due to their durability, portability, recognition, become widely kind of accepted as money, typically precious metals like gold and silver. But you get introduced to this concept called sound money. And I think it dates back to when gold was used as money and people started to mix different alloys to debase the gold, and it had a different sound to it. And so I think the term came sound money, where you could actually hear the sound of a pure gold coin. But the kind of theoretical overlook of what sound money is that it's very difficult to debase, virtually impossible to debase, and society functions better on a sound money standard.
Yeah, and so in our last episode, we talked about the history and the origins of money in various civilizations, and obviously, just like us getting to this point was a bunch of trial and error from many, many, many generations of human beings prior to us. The formulation or the ultimate settlement of gold as the first real form of sound money was ultimately due to the failure of many forms of money prior to that. And again, the Austrians really hit on the monetary characteristics of durability, scarcity, divisibility, fungibility, solubility, as the characteristics that ultimately create sound money. And when you have money, which is a pricing mechanism that ultimately is scarce, and all those other items that is allowed to be used as a median within an economy, you can really ultimately create stable pricing mechanisms throughout time, because again, there's, to a high degree of likelihood, a good chance that that money will still be valuable to everyone within this economy today, tomorrow, in 20 years from now, 50 years from now, 100 years from now.
Right.
And again, prices, as you can see, especially in, kind of use the U.S. as an example, you can go back and look through the late 1800s, early 1900s. The prices of things didn't really vary all that much when you're on a true gold standard at that point in time. And I want to say up until like about the 1900s, bills didn't show up onto the scene. So again, the Austrians really, really hit on the idea that money emerges spontaneously due to market need for a marketable, salable good.
Right. And so, yeah, the fact that sound money preserves value over time and provides stability for economic calculation and just for stability through society. That's a main focal point of Austrians, is this idea that money must preserve its value over time. And as we said in previous episodes, and we'll probably go on it again today, is when money is not scarce and it's easy to make and easy to inflate the supply of that monetary unit, it starts to disrupt the stability of an economy and of empires and nation states. So a key factor that we kind of go back on is anytime you think about what is money, scarcity is probably the most important, and it was for Austrians to look at in terms of their money, that it cannot be debased and cannot be oversupplied to cause this destabilization effect on society.
Yeah, and you see throughout, oh, really, you can go back to many points in time in history, really pre 1900, where most every major civilized society is operating with gold or silver or a combination of the both, working together to form the medium of money. And again, it's the governments didn't decide that. Individuals over thousands of years all came to realize the marketable characteristics of money, and that ultimately is why they ended up as the long run forms of money. Even to this day, the longest running form of money for throughout history had been gold. It's not as widely used today. Obviously, some people still transact here and there in gold, but
It formed
thousands
the
we're talking.
bedrock
Yeah,
of
yep,
economics for thousands of years. And so that really hits on this next point about Austrian economics and their viewpoint on money, is that money is a social convention. Money is a social institution that facilitates exchange, saving, and investment, which are all important factors in society. And so their whole belief is that money can be anything. It obviously has to have these certain characteristics, and be able to perform a function of savings, so a medium of exchange, a store of value, and a unit of account. But it can be anything. And so they have a diametrically opposed view on what most people deem as money today, which is a government issued fiat money that is based on only trust because the government says so. So that's a big discrepancy there between currently what we have and the Austrian viewpoint on what money should be.
yeah. And if you go back even further, you ultimately get this, and I think you really start to see this when you once you understand it. Ultimately, when you're operating on a sound money standard, what is called time preference becomes a big factor. So when you and me and everyone else around us, because we are all individuals who all subjectively value gold as our form of money, we know that it will be valuable today, tomorrow, 10 years, 50 years. So that ultimately, and increase in value, it will purchase us more in the future than it will today. So the whole time preference idea is that on a sound money standard, you have a very, very low time preference, meaning that you have the ability to save for the future. You have the ability to defer consumption and ultimately funnel that capital into, say, a business startup or investing in a business startup, or there are multiple options when it comes to capital creation that you can do when you have the ability to save money. Again, that is what is found on a sound money standard. You have a very, very low time preference amongst most everyone who is using that form of money. And then contrast that with today's world that we live in. I mean, you can argue against it, but I believe that we live in a very high time preference society economically.
Incredibly high.
Yes, incredibly high.
And you're
And
forced to live in it in today's society because of the fact that our money is fiat and it's artificially inflated. And so people intrinsically realize that the current monetary system loses value over time and into the future. And so the incentive structure is such that people would rather spend the money now to get the most bang for their buck, excuse the pun. So spending now instead of delaying consumption for savings in order to build up capital that can then be deployed into expanding and becoming more efficient in business. And so you factor that into society within the actual social construct and social fabric of society, and you can see that the incentive structures completely change when you have a high time preference versus a low time preference. So a low time preference would be explained as my money is safe, it's not going to lose its value, it's actually in theory it should gain value in time. And so the incentive for me is to not spend on frivolous things and rather save and build up, because those savings give me stability. And when you factor that across all of society, if people start saving money and have more stability, you can see what the effects are going to be on the greater landscape of civilization.
Yeah, and when you really get back to the idea of, I don't know why this always pops in my head, but when it comes to like starting a business back on like a true gold standard in like, I don't know, the 15 or 1600s, obviously you had the ability to take out loans, but it was much harder to do at that point in time. You had a less liquid money at that point in time. So you and whoever else that wanted to start this business would ultimately have to save for an X period of time and ultimately to purchase the capital, either the human capital or the physical capital that was necessary to start this business. Again, today it's much different. You can go out and take loans and ultimately, through fractional reserve banking, have the liquidity instantly to start a business. Again, it's just naturally harder to take out loans to start businesses on a sound money standard because banks ultimately have to be very precarious or very frugal with who they lend money to. Again, the failure or the default of a business or a loan on a sound money standard has much larger effects than it does today. Again, you can see that with the FDIC. You can see that with the bank bailouts of 2008. There are a lot of safety nets that play a nasty, nasty effect on. Again, that changes the incentive structure for bankers who ultimately are giving out these loans, or creditors, excuse me. Again,
It's an
it's much
illusion
easier.
of a safety net because
Yeah,
it's not,
yeah,
you think they're
yeah,
getting bailed out, but it's someone bears the cost, and
yeah,
it's ultimately the taxpayer, because they then have to pay more taxes, and the inflation is the tax when you can increase the supply of money to cover up the losses of a business failure when you talk about
yeah.
bank failures. But before we get kind of go down that rabbit hole, I want to hit on the point of how in today's world we are able to artificially expand the money supply, because the current money that we have is backed by nothing. It's just trust in the system. So everyone trusts and believes that, this piece of paper has value, and it's kind of like a collective delusion that we all buy into. But slowly but surely, gradually, then suddenly, that trust gets eroded because price signals in the market start getting completely distorted when the market gets flooded with more and more currency units, i.e., money supply gets flooded in there, and it's not equally distributed. So prices start rising, and then you have people that are on the lower socioeconomic rungs. They're not benefiting from this massive expansion of the money supply, and so it starts getting the stability of their savings gets eroded, and it has cascading effects on almost everything in society.
Yeah, and you can really, throughout history, you can see the effects of what ultimately happens naturally. Again, humans I don't know if the Austrians necessarily hit on this, and I think they do, but the idea that humans are naturally self-interested and ultimately looking to preserve and extend themselves and their ultimately their means and their ability to create certain ends. And in that, in a society where you can create new monetary units and spend them into in an economy where they are subjectively valued, you have a distinct advantage over others. So you can really see that, and it's really not much different than the game of Monopoly at the end of the day. I think you, me, most people listening to this ultimately have played Monopoly at some point in time. You are given X amount of dollars at the beginning of the game. There's a banker, and ultimately the fight is to get out of those dollars and get into the assets that are forms of productive capital. And again, if you add in this wrinkle to a game of Monopoly, and I ask this a lot of times when somebody comes to me asking about Bitcoin or something like that, they're like, "Oh, what do you think the dollar price of Bitcoin is going to be in a year?" And I'm like, "Okay, we're not even." First off, that explains that we're on completely different pages. And then secondly, most of the time I start out with this Monopoly analogy. I'm like, okay, if you're playing a game of Monopoly and at some point in time you realize the banker was slipping the guy next to him $200 extra dollars every time or $400 extra dollars every time he passed go, what would happen? And they were like, well, the game would be over rather quickly because that person would be able to purchase
All the assets.
yeah, purchase the hotels and whatever on the board at a much faster rate than I would. And again, think about that idea as every time you pass go is your 40-hour work week. And every time they pass go is what they've produced plus anything from the quote unquote bank. That's more or less the idea of a government subsidy today, or a bailout, or a PPP loan, or various forms of QE. But again, the game is over very quickly because ultimately someone is arbitraging their direct vicinity to the person who implements new monetary units into this economy, which is literally the board game of Monopoly.
Yeah. So when you are able to artificially inflate the supply, it hurts the people that are not able to benefit from that. And so it creates a lot of issues. So in today's world, how that happens and how it materially takes effect is we have central banks, and central banks are able to lend money into existence created out of thin air. They're able to buy treasury bonds from governments with nothing but the collateral of the treasury bonds themselves. So they literally are just pressing a button and creating monetary units that get flooded into the system. And the people closest to that benefit, and the people furthest away from that do not benefit from that.
Yeah, so what really fundamentally happens there is the U.S. Treasury ultimately creates treasury bonds, or bonds or treasuries, whatever you want to call them. And then they first implement the sale of these bonds to try to monetize this form of debt to various countries, plus the central bank of the U.S., which is the Federal Reserve. So people buy these bonds, and over a certain period, I think there's 5-year bonds, 10-year bonds, 30-year bonds,
30 a bond,
whatever, and you get a certain interest payout. I don't know exactly the rate at which that payout is. I don't know if it's yearly or monthly or whatever it is. I want to say it's yearly, but don't hold me to it.
It's quoted in yearly. So like the
Okay.
10-year, for instance, is roughly
Yep.
at around 4.5%, per year that they pay the interest on. The 10-year is basically the bedrock of the backbone of the economy right now. It's looked at as the most secure, in theory, investment you can make, because you're in theory, guaranteed to get your return because it's the US government. And this is a big factor that most people miss. You will 100% get your return, but we don't know what that money is going to be able to buy in the 10, in 10 years time. And so you're actually getting a return for the risk you're taking, and the risk you're taking in buying a bond is the monetary debasement risk. And what that means is you are betting on the government not rapidly debasing the currency or rapidly increasing the supply of the currency, that 5%, 4.5% yield covers you to keep you kind of at par with what inflation is doing, into the future. So the way I look at it, I think it's absolutely ridiculous and crazy to think that anyone in today's day and age, previously, yeah, obviously it was a little different because what's happening now since COVID, everyone can see it now, is prices have gone crazy. And the Austrians' perspective on this, they believe that increasing the money supply is what causes inflation. And it's clear as day that the fact that the United States government increased the money supply by 40% since COVID, and we've seen rapid inflation, through that time period. So going back to this thought process on buying a bond because it's in theory, the lowest risk, you're lending money to an entity that is continually proven to run deficits, increase its debt, and not be able to pay things back in real terms, but they can pay things back in nominal terms because they have the ability to print money. I mean, it's just an absolutely crazy thought once you realize the matrix that we're living in.
Yeah, it is more or less. I mean, it's again, there's this bell curve of understanding this where at first if you at first it's actually really simple, but there's a lot of terminology that is floated around and used and pushed from certain schools of economics that make it sound like it's very confusing. But you get this bell curve, and it's like, wait a second, this is simple. There's a lot of words, and then at the end you're like, oh wait, this is actually really simple.
Yeah.
And really, what the Treasury paired with the Federal Reserve plus the other creditors that are buying these bonds and ultimately lending to the federal government, what this is allowing the federal government to do is pretty much say, hey, we're going to pay off this last credit card that we maxed out with this new credit card and repeat over and over and over and over. And the game is never up until you ultimately start to have enough people, governments, corporations, businesses that buy and hold these treasury bonds. They start to then realize, wait a second, I'm netting a negative real return. Again, if inflation, I don't know, say a business is trying to buy, I don't know, real estate, and they're financing it via the cash flows from treasuries that are yielding 4%, and the house is increasing it that they want at 7%. Obviously, can't really catch up very quickly going that route. Again, it's a very crazy concept that seems like, just once you really understand it, you're just like, what in the world? How is this how the largest empire on earth has made its living, is just doing this over and over and over again? And then you start to really dig into the different political and geopolitical happenings since the 70s, where the U.S. military has used its
Might.
coercive abilities to pretty much tell,
Monopoly on
again,
violence.
yes, and we've seen this twice. Well, I guess really once, but the petrodollar system that came about after the I want to say it was in the early 70s. 1973 sticks out for some reason. U.S. goes off the gold standard. They need people to buy U.S. treasuries. The world's still trying to adjust to this idea that wait a second, we're going to use the reserve currency that isn't backed by gold anymore. Very sounds like, at least from what I've read, a very odd period for geopolitics. Um, so you get to this point where the U.S. pretty much goes, "Hey, Saudi Arabia, we will, make sure that y'all are very well protected. We're gonna provide you with some of our top of the line defensive systems and weapons, so you can have your um, deterrence in the Middle East. And with that deal, we ultimately want you to price oil in dollars, and we want you to buy. And again, I've heard this rumor. I can't confirm, but there's some people who do talk about the idea that they pretty much strong armed Saudi Arabia into buying treasury bonds at a little bit of a lower rate than they could get on the open market. But Saudi Arabia was funneling some of their um, excess cash and capital that they were acquiring via being one of the largest oil rich countries in the world back into US Treasuries, thus creating this kind of artificially created demand for US Treasuries. Um, and we've seen this play out in some other instances, and most recently, which,
China's one of them, where
yep,
one of our America's biggest trading partners is China. And so, kind of how the flow of money goes there is we as Americans are crazy consumers. And so we buy all the plastic and technology and all the things that China manufactures and makes. And so, China exports their goods here. We buy them with dollars. um, China then receives these dollars for these goods and then needs to do something with them. So they turn around and send the dollars back here for a promise of a good return in the form of treasury bills, secure, stable return. And so this is how the kind of the flow of money goes. But the game's up when the American government gets into a debt doom loop, which we can get into later. But essentially, what's going to happen is more and more people are going to catch on to this game and say, well, you know, the money that I'm getting back in this return is not keeping up with inflation because you guys are spending too much and therefore inflating the supply of dollars, therefore causing the prices of things to go up. And so it's not making sense for me to put this money into this treasury bill and not get a real return on the money. I can rather put my money somewhere else that's just as safe. And that's where Bitcoin's coming in, where there's kind of a game theory now where nation states are starting to adopt this instead of this using the treasury bills as the bedrock of their investments.
yeah. And again, if you go back to the really the baseline of Austrian economics, humans act to A, preserve themselves, and then B, extend themselves and their capabilities and their wealth going forward. For the most part, I think that natural drive is there. I was also thinking, this is a little rabbit hole, but I was thinking about this like today. It's really not that much different when you really think about it. If imagine if like this is going back to the idea that centralized control and creation of new monetary units would be like going into nature with no humans, and then there would be more or less a god that would say, hey, this group of animals gets fed but not this group.
Yeah.
And in doing that, you ultimately ecosystems rely on a, if a singular there. I don't know if it's like I've heard this, so like if bees or ants or something like went extinct, like
The chain reaction.
the chain reaction of what would happen is drastic. So it's kind of not all that much different. Again, we are in a financialized state of nature, and ultimately you are attempting to a preserve yourself. And again, if there is some will straight up call it unfair, which is when you really fundamentally think about it, it is rather unfair that there are certain groups, and this is where I'll first finish this, but again, the idea is that there are groups, and your ability and your relationships with those who ultimately can create money is going to give you a much easier path, and potentially, and I don't mean to sound socialist when I say this, but it's just like the truth. It's just a much easier way to create and ultimately spend these
It's
monetary
not
units or
socialist.
points.
It's
Yeah.
basically giving you creating that the money is able to store its value, and when you take that away, that's what causes the issues. So the whole idea of Austrian economics is money should store value. And today we know that money does not store value. If you're calling the US dollar money, which Austrians and certainly Bitcoiners don't see the US dollar as money because it fails in its primary function to store value. And when it can't store value, it actually starts failing in its ability to be a unit of account because you cannot account with something that is completely untethered to reality where you can just increase the supply of it. So that's where you start. That's where Austrians and Bitcoiners are, basically saying that the current fiat world that we live in is not sustainable. You cannot just keep increasing the supply of money and increasing the debt ad infinitum. You're eventually going to run into an issue. You've kicked the can down the road for so long, and if something can't last, it's not going to last. And this obviously cannot last. It's because it's not a free market. As soon as you have a centralized party that is manipulating money, the supply of money, and the interest rates, and have the ability to pull strings on the economy over and above what the free market actors are doing, you're not in a free market anymore. And so we haven't lived in a free market in our lives, not yet, because of the fact that they're centrally controlled. Um, the the natural state of a free market is deflation when you have a money that is unable to be increased in supply, because humans are naturally going to become more and more efficient. And so when you measure things with a fixed supply, prices go down. And we haven't seen deflation ever in our lives.
Yes, you are right. And this is a very good example. And I have a hard time getting this across to people, but the natural state of a free market is deflation. The Austrians go from money and its kind of origin story. It starts out as a collectible, meaning that people are like, oh, I mean, this kind of naturally plays out this way in a kind of ground up way. But humans ultimately are like, wow, this little gold rock here is pretty cool. And then they realize, oh wait, there's not many of these little gold rocks just laying around everywhere. They're rather finite. So it goes from a collectible to a store value, which we're in this stage of with Bitcoin right now, to a medium of exchange, and then to a unit of account. But this idea of dollar versus Bitcoin right now, if say that everybody unanimously accepted both Bitcoin and dollars, well, over time, as you save your Bitcoin, you ultimately can purchase more with it in the future. We've seen, and I think this is one of a great example because I think that, again, one of the basic foundations of modern Western civilization is the idea of providing a house, providing for a family. So a house is a relatively moderate goal that a lot of people are chasing after. Whatever that is, wherever it is on your own terms. But Bitcoin, the average price, the average house in the US, starting back in 2016, was a couple hundred Bitcoin. Then it got down to about 10 Bitcoin in 2020 and is now at almost 3.5 Bitcoin today. And then you show on the other side of that mirror the dollar system. And these are just basic numbers. I'm just using the Richmond market for this example. Back in 2016, you could get a decent house. I'm going to actually use my house right now, probably for about 200 and some odd $1,000. Then in 2020, it was relatively close to the same, a little bit higher, 300 maybe. And then ultimately 2024, $370,000. So again, your monetary unit that is forever expanded. Ultimately, you are going to see prices increase because I think this is a quote from Milton Friedman, who is not an Austrian, but I think he's the Chicago School of Economics, I believe. A very similar school, but his idea or his quote he's attributed to is inflation is always and everywhere a monetary phenomenon. And what he means by that is inflation only arises, prices only increase due to the fact that new monetary units are created. And what he really means by this is that if dollars were finite, then people would save dollars and ultimately not saving in houses or gold. And again, it would be very hard to make dollars finite with their ease or their softness that allows individuals to create them. But that's the whole idea of a true free market where Bitcoin is a free market money right now compared to fiat. And you ultimately end up with prices naturally falling in terms of the free market soluble money.
Yeah, and this is a concept that I think a lot of people who haven't gone down the Bitcoin rabbit hole and actually understood the mechanisms of money, they still think that they don't understand that they're using houses as money. So real estate investors haven't kind of switched on to the fact that they're actually using houses as money because of the fact that the money is broken. They haven't given it any thought that their money is broken, and they don't ask the question why they saving and storing their value in real estate. And what happens when money's broken, which it is in US dollar terms, you get people that start saving in real estate. And what that does is it adds a monetary premium over and above the utility value of said real estate. And that's what causes the people that can get the loans to be able to buy more and more houses, and the people that can't qualify for the loans because they're further and further away from the money printer. This is the Cantillon effect that causes these factions in society where you've got entire generations or half generations that have missed out because of the artificially manipulated business cycle that the central bank has caused by manipulating interest rates, in order for them to try and slow down and speed up the economy. You cause big gaps in society where certain generations, when they want to get onto that property ladder, are completely priced out of the market because they don't have the ability to qualify for these loans.
Yeah, and it's also funny to think about, like, especially a lot with my generation, which I kind of understand where they're coming from. They have the wrong idea, but I do understand where they're coming from. They see the situation that they are in, maybe relative to their parents or maybe relative to, I don't know, other individuals. And I think that envy is a terrible, terrible thing that has exacerbated itself over society as a whole. But you see a lot of younger Gen Z and millennials calling for socialism, and they think that the capitalists are the issue. And it's in reality the capitalists that they're going after, the Elon Musks or the Jeff Bezos or the very wealthy real estate investor. They haven't realized that they understand the money game. They understand that the game is the acronym GOOD, get out of dollars.
Yeah, and it's
And
not even capitalism; it's crony capitalism
yeah,
because you
yeah,
you have the ability, to manipulate the free market, and the people that don't have the ability to manipulate the free market are the ones that end up losing. So it's
yeah. So
not
that,
it's not pure capitalism.
yep. So again, these people are then calling for socialism and the
More central
redistribution
planning
of more central planning
when
when they don't
central planning is the
realize that,
issue.
yeah, when central planning is the issue. And that's the irony once you realize that
Yeah, it's all a
um,
game.
the, yeah, the modern left calls for this. And I mean, in some cases, and when you really think about it, the modern right is doing the same thing to an extent by
Absolutely,
extending the life of these
institutions.
fundamentally socialist institutions.
Absolutely. So to wrap up today's episode, Um, the key point here is that as a Bitcoiner and someone that's gone down the rabbit hole and researched and studied this, you recognize that Bitcoin is more than an investment in the sense that you're buying something to get more dollars back. This is a fundamental shift in sound money and monetary sovereignty. And when people start realizing that you're not actually investing in Bitcoin just to get dollars back, you're voting for a new monetary order that has fairness and soundness embedded into the bedrock of its foundation.
Yeah, it's actually this like beautiful mix of what the socialists are calling for and what the capitalists are calling for. It's this very weird. This has never happened because there's never been a finite form of money that has ever existed.
Bitcoin is the
That
first thing that is absolutely finite, that has monetary, uh, principles and characteristics to it.
Yeah,
Yeah,
and so it's like
The Mona Lisa is finite because there's only one,
yeah,
but it can be copied.
yeah,
Bitcoin, you can audit it every 10 minutes. It cannot be copied, and it is the first time in human history we have ever come across a money that has a finite monetary unit, and that is fundamental and game changing for humanity.
yep. You show up to Bitcoin in the beginning. You kind of understand the idea of scarcity. I think most people who buy Bitcoin understand it from that perspective, and they're like, "Oh, babe, we're gonna get rich. I'm gonna make so many dollars off Bitcoin." And then you get to a certain point of studying and going down the rabbit hole where you're like, "Wait a second. $1 today is not $1 tomorrow. One Bitcoin today is one Bitcoin forever." And then you're just like, "Oh my gosh, one Bitcoin is one Bitcoin,"
Yeah.
and it's
One
funny.
Bitcoin is still worth one Bitcoin. And
Yeah.
so, all right, let's wrap that up today. I hope that explained a little bit about Austrian economics. I appreciate you giving us your insights with your half Austrian degree, half Keynesian degree.
Yep.
So we'll pick up next time going further down the rabbit hole. Appreciate it, buddy.
Yep.